Thank you for joining today. This is our third social finance chat. We're going to talk today about creating the right financial mix. And this is hosted by Thrive Impact Fund, the new place-based investment vehicle for financing social enterprises on Vancouver Island and beyond. And so I am Emily Nguyen. I'm the Impact Investment Manager for TIFF. I have a background in community economic development and impact investment in France and Canada. Some of you may know, but we have launched TIFF at the fall 2021, and we're really glad to introduce this series of conversation with the community to discuss new tools, impact investing, social finance in general. So I'm really glad to be with you today. We're gonna run this session around creating the right financial mix, and we'll have a Q&A at the end. I'm here today with my colleague, Robin. Robin, if you want to introduce yourself quickly.
Hi, I'm Robin Welsh. I am the Marketing and Communications Coordinator with Scale Cooperative and Thrive Impact Fund, and I'm really excited for this session today.
Awesome, thank you, Robin. So we're gonna start with Thrive Impact Fund, which, as I said, is the new Impact First Fund created to support the growth of for-profits and non-profit social enterprises, primarily on the island, the coast, the Okanagan, and interior BC. TIFF investment thesis can be summarized in 6 key points. We are an impact-first fund, able to adapt financial expectations to impact goals. We are incorporated agnostic, willing to finance the whole array of impact organizations, regardless of how you are incorporated. We are a flexible investor, offering patient and tailored loans to the needs of the investee. We are a supportive financial partner, providing hands-on support to investees. That's very much the DNA of Scale Collaborative, for those who know us. And this comes through coaching and peer learning. We are a place-based fund. We invest where we work when we have ground community presence in British Columbia, so primarily on Vancouver Island, coast, Okanagan, and interior BC. We are a collaborative partner, and we aim at empowering the sector by de-risking it and working with other financial institutions. That comes very much of an important piece here about building your financial mix, because we will work with credit unions, with community futures, with our friends at Futurepreneur, and make sure that you get the right mix for your project. The offer of TIFF, it covers different stages in revenue trajectory, from a first step in revenue diversification to large investments from mature organizations. We provide various types of flexible debt financing and wraparound support to investees to help them succeed. The financing offer of TIFF is composed of 3 types of debt products with the following characteristics. We go up to 7 years. We're flexible in collateral requirements, and most of our loans are unsecured. We're flexible in interest-only periods and risk-adjust in terms of pricing. We have a 2-layer due diligence process, depending on the amount that is requested. And identifying the right tool for you will come through a conversation with me. So how to build the right financial mix? When you consider leveraging financing to grow your organization, it is crucial to look at the big picture and see finance only as a means to your goals. Firstly, and that's what all investors will look at, you need to have a clear vision on what your investment need is and what are the revenue streams that exist or will be generated to repay. This will help you determine what type of financing is the right instrument to build a sustainable repayment trajectory and thrive overall. And having a mission-aligned investor will help you keep your mandate and vision at work. Here's a capital continuum that shows different types of financing available for impact organizations to support growth. It is spread on the traditional risk-reward metrics. We could add a 3rd dimension of impact for our sector. On the left, you have funding and traditional debt, where risk is low, but return to investors tend to be low as well. And on the right, there is equity, where the risk is higher, but the expected return is generally a double or triple-digit figure. Each of these tools come with different forms and outcome for your organization. They all have their advantages and downsides, and you may need to meet specific requirements for each of them. So about timeline, yeah, this is a fundamental way to evaluate what tool is right for financing your project. When do you need the money for to cover short-term needs or a long-term investment like an asset? What type of revenue will your project generate during the lifetime of the investment? And how are the inflows scheduled? And if this will be a recurring or stable stream, or a little less straightforward and will require flexibility in payment. And if you are considering taking an investment that does not self-liquidate, what is your horizon for refinancing? And will your timeline include an exit or a refinancing need at term to pay out the investor? Other key criteria to consider are also the amount. Small or large capital need will orient you to different type of lenders and investors. They all have their thresholds with several compartments sometimes. Collateral requirements. Traditional debt lender demand collateral. And what is your organization able to offer? Marketing capacity. This will be really key in the case of a capital campaign, like community bonds or crowdfunding. Backend and financial monitoring capacity. The more sophisticated the product, the higher is the need for tracking and reporting. Gross margins and growth potential. Well, flexible debt and equity investor will definitely ask you to demonstrate high potential to grow. And the type of incorporation matters because if you are a community-owned entity, like a nonprofit or a charity, you will not be able to access equity investment. Co-op equity investment exists for for-profit co-ops through dedicated funds. All in all, what matters the most in building the right financial mix is to make sure you don't put your organization at risk with taking an investment that exceeds your repayment capacity. Because it will imply that you will not be able to honor debt service, you won't be able to fund your operations properly, and it will compromise too much your financial margins. So remember that financing is supposed to help you achieve financial sustainability and not deteriorate your financial positions. It should leverage you, not undermine your mandate. So make sure you keep money in the company, you avoid mismatch in terms of duration, and that the tool is tailored enough to your needs for a successful partnership with your funder and investor. And they are definitely as interested as you are in the success of your organization to preserve their investment and to build community benefits. We are now going to explore some examples of financing need and link them to potential financing offers. Explain how and why they match. This is a chart adapted from a French guidebook. So for the French speakers, there is an organization called France Active that has tons of great results. So operating expenses. Generally, they would be covered at least partly by the income you generate. You can approach an investor who will consider integrating some operating expenses into the financial envelope, like hiring needs, marketing expenses. Revenue-based financing is really a great tool for that. Investments, whether fixed or intangible, are long-term assets and they require long-term resources. This is very much the basis of a good match in terms of finding the right tool. There are several ways to finance those, and they are definitely the preferred kind of expenses for most financial institutions, especially when they are asset-backed. Here you can approach traditional lenders, flexible debt and capital investors. Lease is a possibility as well, and some come with option to buy. You may be able to leverage investment grants and donation here as well, which can reduce the financial needs and repayment pressure on the project. And so we will send the slides after the session, so you will have all this information. Working capital. Well, this is a very typical line of expense in an investment project, and almost every organization needs to strengthen this piece of the balance sheet. It can be financed by long-term or current liabilities, like long-term debt, flexible capital, You can also use donation and lease. Deficit. Well, deficit is definitely not the sweet spot for investors. And here you will want to reach out to grantors or donors. An investor wants to create revenue and not cover past losses. So they invest in your future success, not your past difficulties. Keep in mind that having a negative equity for for-profit social enterprise can be a huge turnoff to leverage money. Just a couple of very quick real-life example here. You purchase a vehicle. Well, a vehicle, other assets, go for long-term loan, flexible debt and capital, investment grants and lease. You want to hire new staff? This is definitely something that can be covered by capital and flexible debt, as well as your own income or any type of operational grants. Pre-financing of grants is a common need as well, especially in the nonprofit sector. There is some bridge financing offer on the market, specific funds or yield banks. Working capital can be usually covered by long-term loan and flexible debt. Past losses, as we said, will only be covered by grants or donation or extra income that will compensate the past deficit. Rent is an operating expense and can be covered by income, grants, and capital flexible debt. We're going to look at 4 examples now of financial mixes for different type of business growth and type of impact organization, with example of a real estate purchase, a business acquisition, some asset purchase, and social enterprise expansion. Our first example could be the case of a nonprofit acquiring a building. Here you can see in terms of expenses, of course, the asset itself, but also generally it comes with associated fees, legal fees, and other type of consulting, and generally improvement works for the tenant. In terms of resources, the best way to finance real estate is a classical mortgage. And again, here, building the right mix means leveraging the cheapest financing if you can, meaning banks or credit union on real estate will take first rank security. And you may have a capital gap to fill out, and here benefit from flexible debt, vendor financing, maybe a grant if you do accessibility work, for example. A second example, a charity purchasing a business. Here in terms of expenses, we will consider that the purchase is made through share. It can also be asset purchase for business acquisition. We add some marketing expenses to communicate on the new ownership and vision, promoting a community bond campaign as well. You will have generally also professional fees here in order to oversee the acquisition, lawyers, consultants, and vendor support. And the hire of a new salesperson here is projected to boost the acquired business. In terms of resources, we imagine here that the charity gets a loan from their credit union partner, some financing from the existing seller, a donation, but raises most of the capital through a community bond campaign. If you're interested in community bonds, I can provide some more information and expert services after that in the Q&A. The third example here is for-profit cooperative purchasing an asset. In terms of expenses, the purchase of the asset itself, machinery and agricultural equipment in our example, working capital, and some other expenses in the form of consulting and studies. In terms of resources, well, for-profit cooperative can take equity, which then help them leverage more debt. So we imagine here a mix of share purchase, flexible debt, maybe a grant for farming development. A fourth example is here a for-profit social enterprise expanding its business activities. In terms of expenses, expanding a business is generally supported by hiring new people, increasing marketing budget, and benefiting from specific consulting expertise, as well as provisioning sufficient working capital to cover potential cash flow gaps. In terms of resources, Revenue-based financing is really a great financing tool for business expansion, since it comes with a pay-as-you-grow model. You repay the investment by a piece of revenue instead of a fixed payment. If you want to learn more about revenue-based financing, we had our first social finance chat on the topic. Maybe Robin, you can put the link in the chat.
Is that for nonprofits as well, or no?
Yes, it is. Feel free to watch the webinar. Here's a simple financing framework, interesting tool to build your own financing mix and guide you to the key components in question. In this Canva type, you break down the framework in 8 boxes, providing information about the project, the investment lines, resources, partners, and team. Box number 1, the project financing needs. It can include assets, working capital needs, any other expenses. Box number 2, the repayment stream. What are the revenue lines that will be used to repay the loan or the investment? They can come from the project itself or other streams. Here are the type of capital you have identified the right fit. What type of money are we talking about? What are the financing tools that would be best suited for you? And what are the associated potential investors? Have you reached out? Have you identified the right profiles? Here we talk about timeline and capital intake. When do you need the money for? And what are the calendar for capital intakes and for capital and return and repayment? And if it's applicable, is there an exit planning? This is something that you should never underestimate, because postponing the question in 5 years or whatever the term of the loan or the equity investment you take is, it has to be planned from the beginning. And finally, financial monitoring and team. Who will be the team in charge of monitoring the investment intake and the repayment? What's the monitoring need, depending on the tool that you are considering? And the deal structure, and that matters specifically in the case of nonprofits and charities. Do you need to create an independent subsidiary to host your project and the financing? So what is the legal entity taking the investment in? Back to TIF, so quick reminder about our offer. So as you can see, we provide patient and flexible loans and revenue-based financing. So we definitely belong to the flexible debt and capital compartment. What matters to us and the philosophy of TIF is that we can tailor the product to your revenue trajectory. We're more on the equity side, being more risk tolerant than traditional lenders. And when we will look at your growth stage and revenue trajectory and build the right financial tool for you. But also, in considering a general financing mix, we will be additive to the ecosystem and come to fill a capital gap. As explained, for example, in the case of real estate, credit union should take first rank and cover the main part of the deal, and we can come as second or third rank. And we provide investor support for the benefits of all. As an active investor, we offer capacity building to investees to guide them towards success for all the investors and the organization itself through coaching, peer learning, and make sure we keep your mission and impact at the core of the support. So thank you for attending. We're gonna have a Q&A now, and the session finishes at 10, so we respect the time of everyone, but we will stay on the chat if you want to ask more questions. Just a quick heads up that our next information session for Thrive Impact Fund is on April 5th. And the next social finance chat will tackle the hard question of overcoming the fear of financing on April 26th. So feel free to register on Eventbrite. And here's my contact information. Always feel free to reach out to have general conversation, even if you're not sure about your need or if you are eligible. We work with a lot of partners and can also reorient you if it's needed. So now I'm happy to answer questions. We may start with the chat, but also feel free to turn on your mic and camera.
Yeah, so we've got a couple of questions in the chat already. The first one is regarding slide 7 and the capital continuum, if you want to pull that up, Emmeline.
Right.
And Ashley from Supply Victoria was looking for some clarification around the lower reward and higher risk reward on that matrix.
Ashley, you want to turn on your mic and tell me a little bit more about your question?
Yeah, so I understand the lower risk, because with like grants from the government and stuff, you don't have to pay them back. And I understand the higher risk, but I don't understand the lower reward and higher reward and what you're referencing there.
Well, lower reward means grants basically ask for no reward or negative reward since you won't repay even the principal. It's in that sense. And traditional lenders, they will look at very steady project tech securities in general, but also offer a rate that is generally lower than flexible debt or equity.
Okay, I'm not sure if I understand that. I might have to walk through it with you, but thanks.
Yeah, no worries. I can give you more details if needed. It's more about, this is in finance generally how it's assessed, how the capital is assessed. That the higher risk you take, let's say for an equity investor, you will come with a startup project and you really share the risk with the investee. You'll definitely price your financing offer quite high. When, let's say, a bank that finances, let's take the example of a mortgage for real estate. Generally, these are quite safe projects, meaning the reward expectation will be lower. It's lower risk, so it's lower reward. So you'll get a mortgage rate that has nothing to do with an equity rate. And for example, for TIF, we sit in the flexible debt. So we'll be able to look at projects that maybe banks won't look at, that are more risky, share the risk with the investee, but we will also price it higher than traditional debt.
Okay. So it has to do with like rates and what is available to you.
The
and
pricing,
stuff?
exactly.
So
And I
like,
would,
sorry, just so if a funder or like a bank is looking at my financial mix and it's like mostly low risk, low reward things, then I might not get as good of a rate or something.
I would say that if they assess that the risk is low, you'll get a better pricing. This is more how it works. You
Okay.
get a lower rate.
Thank you. Thank you.
Welcome.
So if I could just, to make sure I'm clear, and Paul had mentioned it in the chat too, this is looking from a lender's point of view, right? Not the nonprofits, this slide?
Oh, yeah. Oh, absolutely.
Okay.
It's more an assessment of how the offer is positioned on the
Right.
market. And I would say that something that matters for us is to add impact. It's actually more three-dimensional matrix because we do it at TIF, but equity investors tend to do it also, banks a little less maybe, but for a project that is super high impact, we'll definitely adapt the return expectation to this project.
Gotcha. Thank you.
You're welcome.
We've got a few more questions in the chat here. One of them is, what is a community bond campaign? And Ashley and both Ruby Lecotte would like to know.
I'm just gonna put back the contact information here in case. So community bonds. These are quite a new tool, very innovative. There's been some campaigns in the east more of Canada, not so much in the west. These are basically bonds, so debt products that are offered by a nonprofit to the general public, to any type of investor. Most of them, they start at $1,000 and offer a rate of return that is generally comprised between 3% and 6%. That's mostly what we've seen to finance an impact project for a community. So you can have, I can send in the chat, I'm gonna put the name of this organization that helps nonprofits create community bonds campaign, because there's definitely a big need for marketing. That is called Tapestry. And it's a great tool to leverage quite a large amount of financing, engage your community. It still requires, well, a lot of marketing capacity, back-end monitoring. So it's definitely made for large deals and large organizations. But if you look at Tapestry website, they have examples about community bond campaigns that were successful and that they've supported.
Awesome. We've got another question from Randall Adcock. How do we estimate, measure, and report social benefits or impacts?
Great question, Randall. So for example, at TIFF, we've established impact metrics with each investee. Some of them tackle community development, numbers of jobs created, the investment that is leveraged thanks to TIFF investments, but also project metrics, so specific to the project we finance. And generally, we identify 2 SDG metrics. So we follow the United Nations Sustainable Development Goal. Each fund has its own way to measure. So I think it would depend a lot about, some are very focused on specific sectors. We've decided on our side to make it not too heavy for the investee and definitely prioritize something that they would already be measuring, but be able to report around the SDG framework.
Ashley Howe also has another question. Does scale offer support with finding the right mix of grants?
I would say that our program, Thriving Nonprofits, definitely help nonprofits looking at their revenue stream and how to finance their growth. Maybe not around grants specifically, maybe in a larger vision.
And what is vendor financing?
Vendor financing can come in asset purchase that are large enough that the vendor has interest for the purchaser to access some flexible financing and make sure the deal happens. Meaning you purchase a business, the vendor, let's say it's a 400K deal, he may lend you short-term 100K, meaning you'll pay 300K in advance and they will ask for progressive payment for the remaining part over time.
And we've got one more question from Ashley here, just around the specifics for investee support.
For TIFF, right, so investee support, it comes through during the due diligence analysis with me. We will identify what are the key risk elements of the project and how we can support the investee to make sure that they can strengthen their risk mitigation strategy there. So we will identify if there is a specific consulting need. So far for our investees, the recurring need is financial modeling. Make sure that they can build the right financial trajectory for their organization. But it could be sales strategy, it could be marketing, it could be human resources. And so we will identify a specific consulting need and help you find the right expert service there. Maybe co-finance this need together. And then we do quarterly check-ins with the investees around financials, project management, and impact. And there is a peer group that will happen monthly between investees, animated by us, to share challenges, success stories, and specific needs for support.
Thank you, Emmeline. I guess I'm wondering, like, how do we know what is like the capacity of your support in that area? Because it seems really broad and helpful, but I want to know, like, to what extent or what, you know what I mean? Like, how far does that support go? Is there any caps or limits on hours or how many services that you guys are supporting?
Again, it's 1 hour each month for the peer group, quarterly check-in of an hour with me. And then on the consulting side, generally the contracts we've established is over a couple of months. So January is quite a short-term need from our investees, but that's again something that is very tailored for each project. But we can talk about that, you and me, Ashley, if you need more specifically for you.
Okay, thank you.
We're getting to the end of the session, so we want to respect the time of everyone, but if anyone else wanted to turn their mic and share, I'm happy to hear anyone else. And if not, well, this session has been recorded. You'll find it on Scale's YouTube, and we will send the slides later on today or tomorrow.
And you'll also be able to access this recording through the Scale website on our news page pretty soon here.
Thank you everyone who attended today. And again, feel free to get in touch directly with me. I'm always happy to learn about great projects in the community. And yeah, I wish everyone a very good day.